Ever heard someone say, "I lost half my money in the stock market," while someone else brags, "I just doubled my investments"? Same market, two different outcomes. Why? The answer often comes down to two things most people overlook: risk tolerance and time horizon. Understanding these can literally make or break your investment strategy. And today, we're going to break them down in a way that makes sense. No financial jargon, no complicated charts, just real talk. Let's get into it. So let's bring it all home. Understanding your risk tolerance and time horizon is like knowing the speed limit and fuel range of your car. If you ignore them, you might crash or stall out. But if you pay attention, you can drive smoothly toward your financial goals. Here's the beauty of it. You don't need to be perfect. You just need to be honest with yourself and make decisions that fit your life, not someone else's strategy. Because here's the truth most people won't tell you. There's no single right way to invest. There's only the right way for you. That means your risk level, your time frame, your goals, your comfort zone, your journey. So instead of comparing your portfolio to someone else's, focus on building one that reflects your values and your future. Don't chase hype. Don't invest based on someone else's confidence. And don't let fear make decisions for you. And remember, playing it safe isn't always safe, especially when inflation eats away at your money. But taking on more risk than you're emotionally ready for can backfire too. That's why aligning your risk tolerance and time horizon gives you the best shot at long-term success without unnecessary stress. So take a breath, take your time, and take the next small step toward becoming a more confident, intentional investor. And if you're still not sure where to start, no shame in that. Talk to a financial advisor, try out a risk tolerance questionnaire online, or just start by writing down your goals and timelines. Even small clarity leads to smarter decisions. Thanks for sticking with me today. If this helped you see investing a little more clearly, hit that like button. It really helps the channel. And if you know someone who's just getting started, share this video with them. They'll thank you for it. Subscribe for more honest, no-fluff money content, because we believe everyone deserves to feel confident about their finances. Until next time, invest smart, stay curious, and always keep learning. And remember, your money is a tool, not a goal. Use it wisely, and it will serve you well. What is risk tolerance? Risk tolerance is how much risk you're emotionally and financially able to take when investing. Think of it like your financial pain threshold. How much volatility, or ups and downs, can you stomach without freaking out or selling at the worst possible time? There are three types of risk tolerance. Conservative. You don't like big swings. You'd rather earn a small return if it means sleeping well at night. Safety is your priority. Moderate. You're okay with some ups and downs as long as you're getting steady growth over time. Aggressive. You can handle seeing your portfolio drop 20% without panicking because you believe in long-term gains. Let me give you a real-life example. Let's say you invest $10,000. A conservative investor might go for bonds or fixed deposits and be happy earning 3 to 4% a year. A moderate investor might go with a mix, some stocks, some bonds, earning 6 to 7% on average. An aggressive investor might go all in on stocks or even crypto, aiming for 10% plus returns, but accepting a bumpy ride. Here's the thing. None of these are wrong, but the wrong one for you can lead to regret, stress, and bad decisions. How do you figure out your risk tolerance? Here are a few questions to ask yourself. How would I feel if my investments dropped by 30% tomorrow? Would you panic? Stay calm? Buy more? What's my goal for this money? Retirement in 30 years? A house in 3 years? These answers matter. How stable is my income? If you're on a tight budget or your income isn't predictable, you might not want to take huge risks. Do I check my investments daily? If market drops ruin your mood, you may be more conservative than you think. Being honest with yourself is key. Some people think they're aggressive until the market tanks. That's when the real risk tolerance shows up. Now let's talk about time horizon. Your time horizon is simply how long you plan to keep your money invested before you need it. Short term, 1 to 3 years, medium term, 3 to 10 years, long term, 10 plus years. This matters because investments behave differently over time. For example, in the short term, the stock market is unpredictable. You could lose money, but in the long term, historically, the stock market has gone up, despite recessions, crashes, and pandemics. So if you're investing for a wedding in 2 years, you probably don't want to put that money in high-risk stocks. It's just too risky in a short window. But if you're investing for retirement 25 years from now, you can afford to ride out the storms, and that gives you room to take more risk for potentially higher returns. How risk tolerance and time horizon work together. Here's where things get interesting. Risk tolerance and time horizon are connected. Let's say you're naturally aggressive. You can handle big swings emotionally, but you need the money in 2 years. That short time horizon should make you invest more conservatively, even if you feel brave. On the flip side, if you're conservative by nature but investing for retirement 30 years away, you might be able to take on more risk because time is on your side. The longer your time horizon, the more room you have to recover from downturns. So even if you're not a natural risk taker, you can build a strategy that balances safety and growth over time. So let's bring it all home. Understanding your risk tolerance and time horizon is like knowing the speed limit and fuel range of your car. If you ignore them, you might crash or stall out. But if you pay attention, you can drive smoothly toward your financial goals. Here's the beauty of it. You don't need to be perfect. You just need to be honest with yourself and make decisions that actually fit your life, not someone else's strategy. Don't chase hype. Don't invest based on someone else's confidence. And don't let fear make decisions for you. Know your goals. Know your limits. Know your timeline. When you put those three together, investing becomes a whole lot less scary and a whole lot more powerful. Thanks for sticking with me. If you found this helpful, give it a like, share it with someone who's starting their investment journey, and subscribe for more honest, simple money talk. Until next time, invest smart and invest in yourself. Know your goals, know your limits, know your timeline. When you put those three together, investing becomes a whole lot less scary and a whole lot more powerful. Thanks for sticking with me. If you found this helpful, give it a like. Share it with someone who's starting their investment journey, and subscribe for more honest, simple money talk. Until next time, invest smart and invest in yourself.